loud. Well, great. Thank you, Christy, for joining us today. We have a very exciting topic, life insurance. Yay! Something none of us like to talk about, but we all need to do and deal with. And so I'm excited to have you here. Thanks for joining.
Yay. Well, thanks for having me. And I've got notes, so I apologize if I look down and I realize, depending on my angle, I get sort of penny. And in my 40s, I've got these lines. So if you see them, just, feel good about your skincare routine. So I apologize. But yes, thank you guys so much for joining. So I think on Valentine's Day, it is right to be here to talk about one of the most loving and selfless things you can do for your family. Because when you get down to it, life insurance is all about love. So thank you guys for being here. You're at the right place at the right time on the right day to think about this topic. A little bit about me. I'm Christy. I've been in Asheville for about 11 years. I'm married to Sterrett, and we have a 10-year-old named Sterrett. That is more confusing than we thought to have the same name in the house. We have a Catahoula who's insane named Wally. He might bark, so I apologize. And we're over in Beverly Hills, so we love this little neighborhood. I'm something I never thought I would be 15 years ago. My 30-year-old self is laughing. I'm a PTA mom and a soccer mom, so, here we are. So being a mom and a wife is sort of where I lay my basis in what I do. So at New York Life, I am full-fledged financial professional, so I can do the investments and the 529s and all the big sexy stuff. But my work begins with the foundation, and that's life insurance. So I sort of see life insurance and insurance strategies sort of like foundations and homes, right? I'm sure if you guys have a house, one of the worst things you can hear is there's foundation problems, right? Because without it, bad foundation means house doesn't stand, right? Can't have a bad foundation in a house. It's similar with the financial portfolio. So you can have really good investments, you can have a big bank account, you can have just a huge career ahead of you. But if you don't have a foundation of insurance, one event can send the whole thing down. It can send it toppling down. So that's sort of where I get started. Even though we can talk about all the things, we got to make sure you're protected first. So, like Abby said, people really don't want to talk about this topic, and it's sort of awkward to bring it up at PTA and soccer. So who's having these sorts of conversations? Some people reach out to me. Typically, the people who reach out to me, and this is very telling, are two types of people. People who have lost somebody that had proper insurance planning in place, and people who lost someone who did not have proper insurance in place. Those are typically the two types. So again, people who had proper insurance, you lost someone with proper insurance, or you lost somebody without it. So
I'll kind of jump in here.
Yeah.
I've obviously lost somebody recently, so this is sort of front of mind. And my dad did have life insurance. And now I'm watching my mom, who is a realtor, who had to take a year off, not work, have a little bit of breathing room, because even though he was in his 50s when he got life insurance and passed shortly thereafter, unexpected, he gave her a cushion that she would not have had to survive. I don't know what she would have to do, but maybe she'd be living with us. I mean, it would have made a huge impact across our whole family. So again, not the sexiest of topics, but I think it is a part of the investment portfolio. We love to invest in real estate, but that we don't talk about is the life insurance piece.
Yep. And that's a perfect segue, because it's sort of the questions that we begin with is, and we really want you to think about in the industry is, and I also do disability and long-term care insurance. So depending on the topic, we talk about these. What happens if you couldn't work for 6 months or more? And that might be because of your own disability. That might be because you're dealing with a sick spouse or dealing with grief, right? What happens if you can't work? What happens if you or someone you love has an unexpected long-term care event? And a little ditty about that, that can be upwards of $100,000 a year to pay for full-fledged long-term care. 70% of us are going to need some sort of assistance. And you probably already know who's going to be the caregiver for most of the people. It's the women, right? It's going to affect most of us, and it's most often going to affect us now, like at the prime of our lives when we've got the careers, the things we need to do, the kids, the COVID, it's affecting us. So, and then the most important and the most horrible question, but what happens if you don't come home tonight? What happens if you didn't come home last night? What happens to your family? Are your kids going to stay in their house? Are they going to stay in their same school? Is your spouse going to have to take a second job, or are they going to have to remarry to replace your income? Um, what about if there's a spouse that stays at home or that does, which is mostly us, right? Does most of the things in the house. How are you going to replace that? And if you have a glimmer of concern about any of these at all, you owe it to your family just to start to talk about this. One of the other things we always say is if every spouse knew what every widow knows, there'd be a lot more life insurance. So, you just start to think about it. And again, it's not sexy. It's not things you want to think about. But if you talk to widows, if you talk to people who have either benefited or had a gap, then you start to see, oh, maybe I should give this a little thought. Um, I will say that life insurance is not all gloom and doom. Now, once you get past the basic protection, there's some really cool stuff, and that might be, Abby, that might be another presentation. But when you switch to permanent insurance, especially at a company like mine, where you're eligible for dividends or you have market-based insurance, these puppies can grow. And it's the difference between renting an apartment or buying a house and getting equity in a house. These puppies can grow. And then once they start to grow, you can take money in and out of them on a tax efficient basis. It is wild. It is cool. So a quick example is my son, he's 10. He has a life insurance policy that we're hyper-funding instead of a 529 plan. So the thought is he can take money out to pay for loans if he has them in college. He can take them out to start a business. He can take them out to pay for his own retirement. Companies have been built using life insurance policies. 85% of Fortune 500 CEOs have cash value life insurance, and it is not for the death benefit. It is for how you can structure these and sort of use them tax efficiently, use them as Roth alternatives. So that's cool, that's fun. There's just some neat things we can talk about later because I geek out and it's a lot.
So Christy, can you define for people who don't know the different types of life insurance?
Sure. In general, there's a few different types. There's term and perm. We say term and permanent. So term insurance is really, really good for a couple of things. Term is always going to be your cheapest. So I know when we get off this call, because we're saying life insurance on the interwebs, we are all probably going to get Facebook ads or Instagram pop-ups like, you can get $2 million of insurance for $22 a month. No exam. That's term insurance. So think of it like it's like renting an apartment. It builds no cash value. It's going to be the cheapest way to get things done. It's really, really good for liabilities that go away. So if you have an 18-year mortgage, cover that up in term. We have 20 years left on our mortgage. So my husband's term policy, he has one term policy that follows the mortgage. Maybe when those babies are out of college, cover your income until they're out of college. That could be another term policy. Term is also really good, especially when we're paying for the daycare, the diapers, the braces, the college, like all of the things, and we don't have a lot of money. Just cover yourself up in as much term as possible, and we'll figure it out later. The kicker with term is that if you have any intentions of switching to permanent, which I'll talk about in a minute, you want to be with the company that gives you conversion privileges. And what that means is, so if I have a term policy, I go through underwriting, I'm covered. New York Life says I'm covered. then I can say, oh, Christy was approved for $1 million of coverage. I can take that and now I can apply for a permanent policy no matter what has happened to my health. So make sure if you have any intentions of doing something bigger, you're allowed to do that. And typically, the cheaper the policy, you might not be able to, or you might have a really small window in which to do that. So then we switch to permanent insurance. Typically, it's going to cost more, but just like owning a home, you're going to start to build value in that. And if you're at a company that's mutual, which means I don't have like a stock portfolio, it's not stock owners, it's policyholders that own it, you're going to be eligible for dividends, which will eventually grow the policy. So my son's permanent policy is a $66,000 death benefit, $66,000 in premiums until he's 30, a $300,000 death benefit out of the gate. When he's 65, he's going to have about $1 million death benefit, and about $1 million he can pull out of that policy if he just wants to retire off of that. That's permanent. And somewhere in the middle is universal life. Universal life is built a different way. It's a permanent policy, but your premiums are flexible. So universal life, you always have to stay on top of, because as you get older, your cost of insurance goes up. So if you don't stay in touch with your agent, or if you're like, yeah, $80 a month is great, that's not going to cover your policy, and you might lose your policy when you get older. And the last little policy is variable universal life. Similar thing, but it's got an investment component. So you've got a portion of your life insurance policy in the stock market. So those are the basic types.
So if you don't mind, I'm going to jump in here and interpret as a non-insurance person. So how I understand it, and correct me anywhere I'm wrong, is as a term, my kids are 5. I want to have whatever the benefits, $1 million, just for a number, in case I pass until they're 20. So a 15-year, $1 million would cover, keep my husband would cover $100,000 a year.
Right.
My math might be wrong there, but anyway, I guess it'd be 1.5 million. But anyway, it would provide a certain amount of benefit for my husband should something happen to me, or if he's got the same, vice versa. The permanent is a base value that you keep paying into, and it grows over time, correct?
Yeah. And permanent, and I'm glad you said that, because permanent is also a really good strategy. So what I run into a lot is that people just have term coverage, and the proper insurance to have is the one that's in place when something happens to you. So any coverage is good, but you can do a lot with it. That's why I encourage, just like people wouldn't buy a house on their own, they need to do it with one of you. You need to talk to a professional if you want any sort of value other than the chance you might die within the term. However, if you want coverage after your term, if you want coverage when you're older, like when you're retired, and let's say we all live to our life expectancy, which for most of us it's going to be somewhere in the upper 80s, you need permanent coverage, because here's what happens. If my husband, say, has a 20-year term that we got when he was 40, it's going to have a level premium during that entire 20 years. At the end of that 20 years, New York Life or whichever insurer you're with is going to be like, hey, Starrett, that's awesome. Thank you so much for that $90 a month for the $1 million of coverage. But now you're 60, your term's over. It's now going to cost you $950 a month to keep the same coverage. And at the end of this term, it's going to be $7,000 a month, because then you're going to be 80 and you're a lot closer to the grave. So permanent insurance might be more expensive at the outset, but if you have any sort of legacy plans, if you want to offset long-term care risk, things like that, you want the permanent coverage, because it's always going to be the same, if that makes sense.
So I think this group of people that we're talking to here, a lot of us are moms. So I think the term kind of stuff really can make sense with us as moms. Okay, cool. We've got all these things we need to pay for. Should something happen, here's this. Now, as far as talking about the other piece, the permanent, as far as that fits in with, say, okay, I'm putting money into my kid's college fund, I'm buying investment properties, maybe I've got a little stock nugget here and there.
Yeah.
Where is there a place that you see the permanent fitting into a diverse portfolio? Is that?
Yeah. So, and I guess, and I'll disclose first off, I'm going to go over my husband's portfolio just to explain it. So when I started at New York Life, I was all excited, like geeking out to get my family's policies started. And I went through underwriting and guess who's uninsurable? I'm uninsurable. So, for life insurance, you have to qualify with your age and with your health. And I have a random condition that New York Life is like, nope. But my parents set up permanent insurance for me when I was a child. So we have coverage. As far as permanent, so we have coverage. It's never going to go away. It's paid for, which is super generous. I'm a huge fan of kids' policies. But permanent coverage can do a couple things. For a lot of us, you know, I'm concerned about taxes in my retirement. I don't know if you guys are, but you think about some of the things we do to prepare for the future, which is save for retirement. A lot of us are probably putting money in a Roth account. You can't really you can't do a whole lot of money in a Roth account. But I'm worried what taxes are going to be like when I'm in my 60s and 70s. So one of our strategies is to hyper fund a life insurance policy so this cash value will grow, and you can take money out. You can surrender the cash value. You can take loans against the policy, which isn't as scary as it sounds. And Uncle Sam doesn't know about it. It's all a transaction between you and the insurer. So you can pad your retirement. So versus taking out, $40,000 a year in your traditional IRA, and whoopsies, by the time, Uncle Sam gets his cut, it's down to like 32,000. You can use your life insurance policy to sort of help pad your retirement, help bridge to Social Security. You can also add riders, and this is a really critical part of a permanent insurance policy. So one of the riders that we have is a chronic care rider. So if you have a long-term care need, which typically and this is also, hey, I don't talk about sexy stuff all day, so we'll just go ahead and go with the long-term care insurance. If you have a long-term care need, which is triggered by not being able to do 2 of the 6 activities of daily living, those are bathing, dressing, toileting, continence. I told you it was bad. Transferring and eating. If a doctor certifies you can't do 2 of those, you can trigger a long-term care benefit, which basically we accelerate the death benefit from your life insurance policy. But the really cool thing is you've not paid for separate long-term care insurance. You've paid for something that is a death benefit, tax-free for your family. You can use the money for whatever the heck you want, tax-free, or you can pull these benefits out if you need help and you've not had to fund all these different things. So I don't know. I think it's pretty cool. So I recommend, if you can swing it, everyone has that in their portfolio. It's super cool.
Cool. Go ahead. Does anybody have any questions? I'm sure, Christy, you've got a bunch of other things that you can talk about.
No questions.
No questions at the moment?
Well, I did pull some fun statistics when I was preparing for this. So, 12.3 million US women own businesses. So we're part of 12.3 million women that own our own businesses. We are generating $1.8 trillion in revenue, and we control $22 trillion in wealth. So that's a lot. We're also going to inherit another $28.7 trillion in wealth in the next 4 decades. But we average 83% less life insurance coverage than men. So, and we know, most of the men think they're invincible. So there's a lot of life insurance gaps, especially when we look at what women are doing for themselves and the coverage women have and their families. So, you know, we're more important than a GoFundMe. You know, that's the worst case scenario, is that you see someone do a GoFundMe. And when you think about a GoFundMe, usually it's what? To pay for final expenses, to pay off medical debt. It's not even to pay for income until your kids are out of the house. It's not to do all these crazy strategies I had no idea even existed until I got in the industry. You know, it's not to pay for someone's college or wedding, or, you know, you sit back and you think, if I didn't come home last night, what would I want for my husband and for little Starrett and my crazy dog? Like, what would I want for them? Like, you know, it's, I mean, he would still work, but what sort of life do I want to leave for them? And that's sort of where we start. And then when we get to the juvenile policies, which I told you that I love, I think about what happens if someone becomes uninsurable. We can't control what happens with our kids' health, you know, and we can't control if they pick up bad habits, or if they skydive or jet ski or pilot a helicopter, or things that might make an insurance company be like, I don't know. So if you cover your kids and get that started for them, you are literally giving them a gift, and their family's a gift they might not be able to give themselves. Like I can't get insurance. I can't get it. So I'm a big believer in those policies as well. So I think we covered a lot of the things that we with the questions talking about the different types of insurance. But I think it's good to know like a couple other things to think about with insurance. You obviously want to think about your budget. You guys probably, I mean, how much are your clients approved for, right? It's, people think about budget all the time, and it's a big factor, but you can choose how much you pay for insurance and how long you pay for it. Do you want to pay for your whole life? Do you want a term? Even with the permanent products, you can fund those. I'm only paying into my son's until he's 30. We've structured it that way. That's how it's going to work. Do you want it in the market? Do you want it as safer money? I mean, there's a lot of ways to think about that. And then you can customize it with riders. Do you want those benefits, like a long-term care benefit? Do you want protection if you become disabled? You know, there's a lot of cool things. Do you want to build it so you have tax-free access to it, because you've got to build it right, or Uncle Sam, shocker, won't let you do that. So you've got to structure it right on the front end. How long do you want it? Things like that. So there's a lot of cool things to think about. Another thing to think about is the company. So I'm going to jump back to something I said earlier, how we're all going to get Facebook ads for this after. Hopefully, for all of us who have insurance policies, we're not going to see a payout on these for decades, right? Decades down the road. And obviously for kids policies, 100 years. I don't even want to think about that. But you want to make sure you trust the company. You want to look at their strength. I don't know. You want to make sure that they're good. You want to see if they pay dividends. You want to see their ability to do what they say they're going to do. So, you know, it would behoove you just to make sure they're not just a flash in the pan company. There's someone who's actually been around. They have assets. They have reserves. If there's a pandemic happened and a huge influx of people, there's a bigger influx in death claims. What does their portfolio look like after that? How are they holding out? You know, so make sure you do your research on the company too. And, you know, if you're going to be in business with them for the next few decades, make sure they're a company you actually like. Like, do they do good things for the community? You know, so just a couple things to think about. So what questions do you guys have?
Kristen James, late to the game. We're talking about life insurance today. Sexy Valentine's Day topic.
Yeah.
Does anybody, let's see, we've got a couple of us still on here. Does anybody have life insurance?
I was gonna chime in. I'm gonna keep my video off because of my poor internet, but hopefully you can hear me. Thumbs up if
Yeah,
you can.
yeah, you could.
So, like Abby, I will give a testimonial for all that she's saying. Praise freaking Jesus. My dad had incredible life insurance policies to set my mom up for incredible success. One thing he did not have was long-term care insurance. He had unexpected diagnosis of Alzheimer's at 60. I mean, he was in a care facility in 2 years. It almost wiped my mom out. And he was an incredible saver, an incredible businessman. She was spending $20,000 a month on
Ugh.
private care for my dad at the age of 62. This is just insane. So it's like, it's definitely one thing which I've like kind of taken like a life mission of like educating people on, once you hit a certain age, and most people don't think that's 60, or you don't realize that how soon that can creep up on you. Definitely something to think about. I remember when I got pregnant, we went to see our insurance person just to talk about, I don't know, car insurance. And she like literally wouldn't let me leave without life insurance. She's like, no way, you have kids, you have someone that's dependent on you. You've got to have life insurance. So I personally do have it, which I would love Christy to talk to you individually, because I need to revisit, we did it years ago when we had a different house and all that stuff. So I'm all here for this. I know that wasn't a specific question, but I'm here for it. I love it. This is an incredible topic. And yeah, hopefully that helps somebody make the decision too. Very important.
And Kimmy, and I'm sorry that happened to your dad. It actually, a similar thing happened to my dad, and he was also a great businessman. His best friend was an insurance broker, so he actually had long-term care insurance. And he got sudden onset dementia. No one knows how, where, but at the start of COVID, and he was in care for he passed in the spring. It's been about a year, but he about 2 years.
Wow.
And I think about like for him, the when he went into care, and it was he could still remember like the older stuff. It was just it was the short term memory, and it was very very bad. But he knew enough to say, "We can't afford this. We can't do anything." Susan, my mom, Susan, are you sure? How are we paying for this? And she's like, well, you set up the policy, you did the right thing. And that was his care. So to think like someone like that, he was a banker who spent his entire life being cautious and planning and thinking and just stacks of insurance, that it could have all been undone had he not had long-term care insurance. Because again, it was probably $250,000. It could have just
100%.
been gone. And it's just, so yeah, so long-term care was actually the first extra license I got. I got it like 2 weeks after New York Life contracted me, and they're like, are are you sure you don't want to go after your securities license? I'm like, nope, I'm gonna do long-term care first. I just am. It's because, if and I do have the securities license, but let's say, I don't know, I help Abby with a huge investment portfolio and a rollover, and we're doing all this stuff, but she doesn't have long-term care insurance. Again, what we said, you're just gonna decimate that. So, and 70% of us guys are gonna need some sort of help as we get older. If we make it to 65, 70% of us will need assistance. So it's not that's a greater chance than a big house claim. It's a greater chance than the phone claim, your car.
Yeah. And so, yeah, like I said, exactly. So one thing I could say, especially if any of us on here have parents that are over the age of 55, which I'm sure we all do, definitely consider it for your parents, because that's the last thing you want to skimp on is their care. It's incredibly important. And you just want to make sure, and it will kill a caregiver. Like my mom, it was going to do it for her. So thankfully we had the means, but definitely something to think about. So thank you so much.
Yeah, thank you. Yeah, and then long-term care insurance too is one that you may not qualify for. So especially, getting it before you're 60 is really pertinent. I've seen some people pass through underwriting at 65, but it's harder to do that. So, have these conversations, and that's why I think it's good. People don't want to talk about money. I don't feel like, and they certainly don't want to talk about death or having, help with continence or bathing or things like that, right? But I think it's important to have these conversations, and specifically the long-term care. You really do have to have that and have it early so you can start to make those defensive moves against it. Sexy topics. Happy Valentine's.
Well, I think, we're women here to support other women.
Yeah.
And sometimes that means talking about the things that no one wants to talk about
Yeah.
because it's real, because we're wiping kids' butts. We're probably gonna wipe our spouses' butts. I don't know. Like,
I'm not. I got him a long-term care policy. So.
I got
I'll
myself one,
surprise.
so nobody needs to wipe my butt,
Yeah.
ideally. Yeah, the parents dealing with this kind of stuff, I think I read something somewhere where it said humans have 100% mortality rate. We just do, and if we don't confront or talk about or be open with each other about these things, then who are we going to be open and talk to about? And then how do we make sure we're protected and protect our investments?
Yeah. And I also think, and this is I don't know, I haven't been in the field. Like I have some mentors that have been in the field 40 years. They have all sorts of crazy stories. Since I have started, I have had 2 clients get cancer diagnoses literally a week or 2 after we've delivered a policy. So you have to qualify, we talked about with your health and your age, but if something happens after, and if you, with New York Life at least, if you take a payment with an application, you're covered through underwriting. You might get declined, but if something happens during the underwriting process, you're covered. But the point of all that is, I've had a few, and they were both men whose wives were like, do the thing, just do it. And we had to sort of, collaborate to get the men to do the application. And had they not, they would have no life insurance, and they've got it forever. So I think, some of these financial things and whatnot, when you get the call to think about it and you get, find yourself in a situation where like this, where you're talking about it, where you're thinking about it, just do something. Because a lot of people put this off. I think that diagram I learned in, the leadership classes or the psychology classes, where it's the important and the urgent and the not important. Life insurance is important, but most people put it in the not urgent pocket, because we've got work and butts to wipe and PTA to attend and dogs to walk and all of that. And then it gets put off and it gets put off and it gets put off. And I think it's one of those, done is better than perfect, right? So especially if you work with a professional versus just going to the Facebook ad you're going to get, right after we talk. If you work with a professional, you can set up a structure where even if you can't do a lot now, even if you're not in the capacity, like in the spot where you can do the big plan with all the bells and whistles, just do something. But no, if you want to do more, build it that way to get started, but get it done. Done is better than perfect, because you never know what's going to happen. You never know if an appointment's going to, with a doctor is going to come back with bad news. Like, I hate to be that way too, sexy Valentine's Day, but you just get it done. You deserve it. Your families deserve it. So I think it's important stuff. Clearly. I've been doing it for a while.
You do deserve it. You deserve to take care of yourself and your future and your family's future.
Yeah. And your families deserve it. Like, you guys are, we're the heart of the home, but we also we're an economic force. We're doing the things, and we're doing way more at the home probably than other people are in the home. So we have a lot of value, and we need to do that and take care of that.
Oh, that's awesome.
Yeah.
Ladies, anybody else have any questions or pressing things to talk about? Yeah, Beth, go ahead.
So my parents are almost 80. And got sun on my face. So I just moved them here. I don't know I guess I should probably check in with them and see what kind of coverage they have. Mm-hmm. Do most older people have this coverage, or is something I should bring up with them?
Long-term care?
Yeah.
If they're 80, they're not going to qualify. They're going to be too old.
They're too old.
Yeah, qualify for any plan. But they might have. These plans have been around since the 80s, so they might have signed up for something. Or they might have one of those riders on a permanent insurance policy that would allow them to accelerate the death benefit to help pay. So you should ask them, and I'm happy to help you look at anything you've got.
Okay.
Yeah.
Thank you. What is the best age to start long-term care insurance?
I have clients like my husband starting as early as 40. So long-term care insurance, and I'll just dive into this really quick. There's really, in New York Life, there's 3 ways to cover it. One is our plans that are very much like your car insurance or your medical insurance, where you pay into them. And if you never receive the benefit, then good for you, Beth. Like, you've covered your risk. Yay. So those don't tend to be as expensive. Those, they're sort of the risk-based scenarios. Then, like we talked about, you can add a rider to a permanent insurance policy where you can accelerate the death benefit to pay for the coverage. Or there are plans that are linked benefit. Ours is called Asset Flex, where you can move over an asset or pay into a policy that's either usually a life insurance policy with a pot of money, or a bigger pot of money for long-term care benefits, or you can just cut and run after a certain amount of years. So the point of all that is, typically with those plans, you want to start the life insurance linked plans. The earlier, the better. For the permanent life insurance with the rider, really whenever you want to set those policies up. You have to be 18 to have that rider added, but you can do that whenever. The Asset Flex, the one I talked about with the pot of life insurance money, the bigger, I work with a lot of clients actually in their 50s and 60s, have these permanent policies that are really big. Kids get grown, mortgage is paid off, some of the liabilities go away, and they come to me and say, you know what, Christy, I don't really need a $300,000 life insurance policy anymore, and I don't need the cash. We transfer it to one of these policies. They never pay a dime again. I just did it with a client. He had $150,000 in the life insurance policy, didn't want to pay the policy anymore. We transferred it. He now has $150,000 death benefit or $700,000 of long-term care benefits, and he doesn't have to pay an additional dime. So that's why that one's called Asset Flex, because it's literally like flexing the asset. So that one can be done a little bit older, but you have to qualify again. And then the ones where you're paying like your medical insurance or your car insurance, 40s, 50s, that's a good age for those. And of course, they get more expensive the older you get. So like my husband's policy covers $100,000 in benefits, which I realize by the time he needs it, it's not going to be a ton. It's $40 a month, you know. If someone I've got a client who's, how old is she? She's 68. $100,000 in benefits is going to cost her like $180 a month, you know. So it just depends. But yeah, so those I would start at least thinking about it in your 40s. What other questions?
Well, I think this is great. I really appreciate it. And we'll make sure that I have a list of people that attended, and make sure that your information is sent around.
That'd be
If
great.
anybody wants to nerd out on
Yeah.
life insurance and
It's
investing. I'll talk 529s all day, but you start getting too deep in some of the long-term riders, and I'm like, ooh, I don't know.
Yeah, I mean, it's cool. Just a quick plug, we are doing so we have this guy, you can Google him. His name is Ed Slott with 2 T's. So he's one of the experts on how you can access money in a life insurance policy on a tax efficient manner. He also is sort of it's not an alarmist, that's not the right word, but he's one of the people that brings up the very good concern of like, what are taxes going to be like when we retire? And this is why you should start to think about it now. He's doing a session with us. When is it? On Thursday.
I just added it to the chat.
Okay. Yeah, so he's having a webinar. So if you guys want that, let me know. I'll get it to Abby and she can get it to you guys. But it's really cool. So
I just put the link in the chat.
okay, cool. Oh, yay. Thank you.
You're welcome.
Oh,
I
yeah.
have it on my calendar. I think it's gonna be nerdingly interesting.
It is, and then you'll leave and you'll be like, "Oh my God, everything I heard was wrong," like because I remember with the retirement specifically, just the very bird's eye view of the concept is traditional IRAs. I remember my HR people and the people who came into my workplace, well, take the tax break now, because how bad will your taxes be when you retire? Huh. Well, crap. I don't know. They might be pretty bad considering the way it's going. So, I mean, there's going to be some changes in 2026. We know that for sure. I mean, those are some big changes. And then what happens after?
Yeah.
So, for what it's worth.
Well, I appreciate that. And that's shared to everybody, and we'll share that in the group as well.
You're fine. We're fun for Valentine's Day. I wish I had some chocolate I could throw at you.
I don't know what the digital version of chocolate kisses is, but I'll figure it out for the group.
Focus.
Well, thank you so much. I really appreciate you. And I personally will talk to you soon about my policy.
Yeah, and you guys, Abby will send it out. Let me know. I'm a big fan of meeting for coffee if we can't meet virtually. I do a lot of this room a lot all the time. So I can meet for coffee or I can meet here, whatever.
Wonderful. Thank you so much.
Awesome. Thank you. Y'all have a good
Appreciate
day.
you.
You too. Bye. Thank you.